Let's talk to a professional about this market stuff. David Kudla, founder, chief executive officer, and chief investment strategist for Mainstay Capital Management. David, thanks so much for joining us here. What did you make of the move yesterday by the Treasury to step into the bond market?
Well, it is Paul, it's an act of desperation. It's not a structural change. It's an intervention. We've seen this with Japan over many, many years to defend the yen, and it'll last some period of time. And we've already seen a lot of unwind of it today. It's an act of desperation. They're in panic mode.
It feels like Treasury is throwing a lot of things against the wall to try to keep borrowing costs down. This is not the only thing. They also intervened with Japan in the currency market to support the yen. And a lot of people say that's to prevent Japan from selling Treasuries and pushing yields higher. What would actually make a difference in terms of having a lasting effect?
Stop spending, Scarlett. Right? I mean, we all know it. They need to stop spending. They've literally, the U.S. has literally doubled. We just passed 40 trillion. It's been all over the news. But half of that debt was created in the last 10 years alone. We've doubled it in 10 years. So the problem is, that the problem continues to get worse. There's no political will to solve it. But in fact, they continue to make it worse. And we all wondered, when will deficits and debt really start to affect the markets? Because for a long time, there was that belief that the deficits and debt could continue to grow. They didn't matter. They didn't matter in certain quarters. And I think this is evidence now of how this is coming home to roost. And it's probably been accelerated because of this vicious cycle we're in. Some call it a doom loop, but I call it a vicious cycle. They have debt that is growing, so they have more debt to finance. Now, interest on the debt or debt service is higher than defense spending, the third highest expenditure in the federal budget. And as they borrow more, or as the debt service increases in cost because of rates or just increases more debt to service, they have to borrow more money, which we just end up in this cycle, this vicious cycle it's extremely concerning.
Right. So how does that impact your investment outlook here, David? Stocks, bonds, commodities, all that?
Yeah. So for a while, I would say, for many years, it hasn't been a significant impact, but we knew this was coming. So take a day like today, right? Stocks and bonds are both down. What's up? Commodities, gold, silver, miners, the soft commodities. One of the funds that we like, and we've talked about it before on the show, is HGER ETF, the Harbor All Commodity ETF. It's a third in gold, a third in oil, and a third in soft commodities. So if we looked at what oil has done here over the past couple of months, we look at what gold has been doing over the past month and a half, and we have soft commodities like wheat, rice that are setting multi-year highs. That fund has done extremely well for us. And that's what we did. We talked about this, Scarlett, last year about this time, about how much we like the silver and gold trade, that we broadened that to broader commodities. We've come back into gold a little bit here recently, but the broad commodity trade is where it's at in this kind of environment, this inflationary and spiraling debt issue. Hold hard assets.
Hold hard assets, yeah. Perhaps real estate as well, if you've got it. And we certainly see a lot of green arrows in the commodities complex. David, thank you so much. David Kudla is founder, CEO, and chief investment strategist at Mainstay Capital